I love residential real estate. We will always hold a large portion of our properties in residential because I think it's just the most sustainable asset class, right? That's like human necessity. It's housing, especially in a market that, if there's an undersupply of housing, like that's the safest real estate you can have. That's most predictable and has the best, loan terms and things like this.
Yo, what is up, everybody? My name is Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast, the show to listen and watch if you are an experienced real estate investor looking to scale your investment portfolio to the moon. I am psyched out of my mind today to have Mr. Zach Lemaster, CEO and founder of Renter Retirement, which is the nation's leading turnkey investment company. Zach is a seasoned real estate investor and licensed broker who has accumulated a large portfolio of rental properties across multiple markets, including single family, multifamily, commercial, and new construction. Zach is a licensed optometrist who practices on a volunteer basis. Definitely want to hear about that story as well. This show is going to be a little bit different because, typically we bring on investors, how they did their first bigger deal, or what was bigger for them at that time. And Zach's story is really interesting in how it's kind of evolved from residential to commercial, back to residential again, and what he's learned during that process. So I don't want to tell Zach's story. I want him to tell it. So thanks for coming on the show, Zach. I appreciate it.
Matt, super excited to be here. Thanks for the great intro. And yeah, excited to run through everything.
Excellent. So first question is, you were born, now you're here. What happened in between?
And, went by just like that, but there was probably quite a bit of stuff on the, so I was born in Wyoming. I'm from Wyoming. I went to undergrad there, University of Wyoming. I decided very early on in my life that I wanted to be an optometrist. Probably I was, 10, 12 years old because I had a lot of eye problems. I've had multiple eye surgeries and eye care and all the things over time, and really connected with my optometrist and enjoyed that. So yeah, I decided I want to go to optometry school. So I went to grad school in Oregon, and that's where I met my wife. She's also an optometrist, and I was on scholarship with the Air Force. So I went directly after optometry school. I was commissioned as a captain in the Air Force, practiced optometry there for, 6 or 7 years. Ended up leaving the Air Force, moving out to Colorado, which is where we're at today, owning private practices, and then eventually retiring ourselves from that career path through real estate investing. And that's not because we didn't like that, Matt. That's because, we, like, as you mentioned, we're still licensed. We do a lot of work on a volunteer basis, helping people, but it's a lifestyle now. We were able to practice on our terms and actually have a bigger impact through some of the volunteer stuff that we do. And that was all made available through real estate investing consistently over time. I started investing when I was my first professional career path. So captain in the Air Force, immediately commissioned, probably within a month of going to my first duty station. I bought my first house, which is a duplex, rented out half, lived in the other half, the house hacking thing, and fell in love with the real estate. I thought, what a beautiful concept. I can own an asset that I borrow some money from someone else to acquire, i.e. the bank. I used a VA loan, so I put zero money down on it. And I was able to have the tenant pay the loan off for it. And I also live for free, right? So all these things are great. Tax benefits, all the things. And I didn't really even fully understand real estate, but that was probably about 15 years ago at this point when I bought that first duplex. And I always tell people from that moment on, I was sold, and I bought real estate every single year. I'm not saying I made money on all deals, but I bought real estate every single year since then. But there's this pivotal moment, Matt, where it changed the trajectory of our lives and our business. And that's where my wife and I started to be paying attention to investing out of state. Just because our local market wasn't that attractive. We did invest locally first, but we wanted to be conscious about, hey, where's the best market to invest? Where can we achieve the best returns, right? Where can we have the highest cash flow, the highest appreciation? And so through some trial and error, just identifying different markets, we started to diversify our portfolio across the country, mainland residential, single family, and small multi, and just really were successful with that. We had a lot of properties that grew in appreciation really quickly, just being in the right market at the right time. And that's part of diversifying. And then so we 1031 exchanged those and sold those and just scaled up. And we're able to replace our active income and career path through doing that. Now, as you mentioned, over time, I've also gone through some 1031 exchanges and scaled up into large retail centers. And now we're kind of doing the opposite and go back and forth. But yeah, that was a birthplace of Renter Retirement. It's just focusing on, what are the best markets to invest in and how do we strategically invest in those areas to achieve the best returns and scale our portfolio. So that's about as quick of a story as I can give you on where we're at.
All right, all done in your life in under 5 minutes. Correct. So, one area I want to dive into because one of your topics you talk on is scaling a real estate portfolio while you are working. All right, and a lot of investors run into this thing, what I call the scale dilemma. Right, you can hold down a job, maybe have a couple kids at home, and maybe hang out with your spouse once in a while, and you get beyond a certain point of, like, let's say 5 rental properties, and you don't have the economies of scale yet to manage it yourself, and you run into that problem. A lot of people do, and a lot of people like that are clients of mine want to figure out how to scale into commercial. How did you manage the scale dilemma with you and your wife while you were kind of like growing and managing and all that stuff?
Yeah, I think there's different pieces to scaling, and real estate is a beautiful thing. Most of us use it as a side hustle to start. We certainly did, right? It was more just like a little bit of a hobby, and then we kind of looked at it like a business, but as a side business. And I think real estate is great and attracts a lot of people because it can be a side hustle where you don't have to like immediately quit your job, even though some people may want to ultimately get there. Um, but as you acquire more assets, it certainly can take up more time, and to be able to scale. And this is true not only in real estate, but in business, like you need to start putting systems and people in place and like kind of firing yourself from each one of those positions that most of us start doing, like property managing, dealing with the tenants, doing the accounting. I think the more I've learned over time, there really is like the best utilization of my time, right? The best return on my time is really important in the business world and investing. And so I'm constantly looking for ways to replace myself. And early on, I just didn't realize that, and that's true in real estate too. I was self managing a lot of the properties that we owned. I didn't necessarily enjoy that. This was pre kids, so we didn't have any kids at the time, and maybe I had a little bit more time, but that gets old really quickly. And it also just, I've come to realize that, yeah, that's not the best utilization of my time. So as we started to scale, we started to put better teams and systems in place, hiring things out, property managers. Was a big one, and it's hard to find good property managers, right? And then even on the accounting side and the operation side, and just adding, always replacing yourself. The other side to scaling, which is difficult, is the money side, because everyone runs out of money, right? And there's limited capital. It's capital's most limiting factor, and we only have so much money to put as down payments. And so that's the other piece that I think is hold a lot of people up. And you kind of get into this scenario, at least in the buy and hold world. No matter what asset class you're looking at, it's like you invest, you use a down payment, use leverage, and then you may have some good cash flow or whatever, and then you're building up for that next down payment, right? And it's usually people buying these chunks. One thing that helped me early on is I was so scrappy that I was able to have multiple side hustles. Like we even did some flips and some wholesales early on to earn money to buy more rentals. I was always one of these guys. I was like, I just want to own more properties because I like the idea of cash flow. Yeah, I could earn 50K on a flip or something like that. That was a pain in the ass to get through, but it's all about like how do I get more rentals. So earning, there's like financial offensive and defensive stuff, reducing your expenses, earning more income, saving in taxes is the biggest offensive and defensive play that you can make, and real estate provides for a lot of that. So I mean, we were able to scale our portfolio, be like firing ourselves and hiring better people to handle the operational side so we could focus on growth of the business, which is the most important aspect. Then also utilizing all of our resources, like investing through IRAs, HELOCs, partnerships, selling properties, 1031 exchanging, limiting the tax liability we have on our active income, reinvesting that money. And so I think, there's a couple different things that are really important to consider when you're focusing on scaling. But we just kept like trying to always implement those things and find more resources to scale over time each year.
Now, we would be remiss without talking about your commercial experience. I want to talk about what you learned during that, because sounds like you sold some properties, 1031, got into the retail space. First of all, I want to kind of talk about like the seminal moment, because a lot of investors are like, hey, this single family, small multifamily space is kind of comfortable. Why don't I just scale there? And you decide to take things in a different direction, like I did, and a lot of other investors do. So tell me about that, like that moment where you kind of like launched into building out a retail portfolio.
Yeah, I kind of always looked at commercial retail centers even before I really knew much about them. I mean, I knew Mace a little bit. Like early on, when you're a residential investor, those first 10 to 20 doors or whatever it is for each person, um, it may seem out of reach a little bit. You're kind of focusing on residential real estate, and I love residential real estate. We will always hold a large portion of our properties in residential because I think it's just the most sustainable asset class, right? That's like human necessity. It's housing, especially in a market that, if there's an undersupply of housing, like that's the safest real estate you can have. That's most predictable and has the best, loan terms and things like this. But I was always interested, like, hey, it would be cool to own a bunch of retail centers where, in theory, you have these tenants that are in triple net leases that are staying forever, their businesses, and these things are just like super passive and cash flow just forever, and like you can retire off of those. That was kind of the initial idea around, and I looked at a few different retail or commercial centers. We did some small multifamily at that point as well. So we had technically some commercial multifamily. We've looked at industrial and the office, and where we kind of settled was like small strip centers. And these are like A, B class assets, new construction. We would buy them. I didn't want to do value add. I wanted something that was stable, right? This is a long-term hold. And the first one we acquired was through a 1031 exchange. And I kind of came to the realization of like, I need to invest a lot of money, like 7 figures of money from that I built through residential real estate. And it's going to be difficult to do that looking at a lot of different, single family or small multi. So there's also that like economies of scale aspect, just investing in a bigger project. Then from there, because we own 11 retail centers through in Northern Colorado. That's where they're all at. They're all professionally managed. And they're okay. There's obviously issues with some of them that I learned throughout the process. But from there, like once we started to earn really good money from our business as well, it's like, hey, I actually need to invest this money, a large sum of money at one time. It's easier to go out and buy this commercial center than trying to, negotiate all these little deals. So that was kind of the impetus behind that. But what I found over time is that, those are good asset classes, and no asset class is perfect. There's always things that you learn, but dealing with banks, man, what a pain in the neck. Dealing with banks and their contingencies, and they're like, that's been the bane of my existence, is dealing with banks on the commercial side, and just trying to wrap up capital. And then of course we have some tenants that, you think you have a 10-year lease on a triple net lease on with a retail tenant. You're like, oh great, there's escalations built in the rent, like this is how it's going to perform, and then they go dark, right? And then they go out of business, and like, you have like $700,000 that they're supposed to pay throughout the term of that lease, and they're just gone, and you still have to pay the mortgage, the expenses, the taxes, the insurance. All those things are on you now, so that's challenging. And I've just realized that they don't always work out as you anticipate. And one big issue that we found out about is like, not a big issue, but one buying thing is that we would buy new construction centers that are leased. The developer would build it, they'd lease it, and they'd have their analysis, their offering memorandum, and then it's like basically a hyped up P&L or a pro forma, and they show you all this performance or whatever. But a lot of times, like these new developers, what they'll do, because as all your audience knows, real estate is based on a cap rate, right, and the performance of the property. And so they will incentivize tenants to come in and sign these leases for these 5 and 10-year terms. Maybe they pay them or offer them these super like great TI, like they'll just make the sweetest deal for them to get them into the property without really underwriting them really well. But they'll jack up their rents and make it a super sweet deal, not really setting them up for success, but hey, that creates huge income on the property and increases the NOI so they can sell it and earn more. And then you inherit that. All of a sudden the taxes go up 3x because it's reassessed and the tenants are struggling. And, they didn't really have a good broker helping them underwrite the deal. They got all this money up front, but now they actually, all the, pipers come in with having to pay the new landlord these expenses and these taxes. And anyways, we went through a lot of that where like the first year wiped out maybe 20% of our tenants because they just weren't set up for success. And we bought that property at a premium because, the developer, that's their strategy, and you can't blame them for that. But, so those are just some of the things to be conscious about when you're looking at like maybe some retail type stuff. But overall, it's been pretty good. We've mainly bought them for tax purposes. We do the accelerated depreciation on all of them, and that's been huge. That helps us to reinvest our money. And some are negative cash flow because it takes a year to lease. This past couple of years has been difficult. We've had some vacancies for like 18 months. That's hard to stomach, but having a diversity portfolio and reserves helps with that as well. So I could go on and on, but those are a few of the challenges.
Yeah, I did not know that. I mean, I'm familiar with it in the residential space. I mean, there's apartment deals that we've looked at where all right, you got rents that are above market rents on, I think we looked at a 160 unit apartment deal last year, and things just weren't adding up. Rents were above market based upon the product type. And it was like, 100% occupied. We saw that there was, when we did our due diligence looking at, rent.com, apartments.com, and also mystery calling the leasing office, like they were offering like 2 months free rent, no security deposit, so they were just like getting in anybody on here to basically like, artificially beef up the rent roll. And, one of the ways that you're able to avoid that is by, hey, we want to see 12 months worth of bank statements so we can see the cash inflows and cash outflows at the property, and make sure it's somewhat in line with what the financials you're providing, and then find out is like there's no way that's even possible. But I did not know that there was a dirty trick that's in the development business, because like I'm familiar with triple net lease deals. A lot of like institutional investors, like a company in our town called Broadstone Triple Net, they buy single tenant deals from developers. I'm like, dude, I want to be like where the developer is, not like on the other end buying it after they've done what they've done with it. So a little bit on deal sourcing, because I want to get into the single family business and why you did transition. But on deal sourcing, like 11 retail properties, I mean, that's a pretty decent sized portfolio. What was your methodology and system for actually getting in front of these deals to take them down?
Yeah, nothing unique. These were not off-market deals. These were through brokerage relationships. You know what I mean? That developers or owners would sell. Not all of them were brand new construction from developers. Well, we bought some existing ones, but they were all fairly new within 10 years. That's just kind of my goal, because I'm going to hold them for 15 to 20 years. And then likely 1031 again into other things. And so, yeah, but I mean, these were just typical on-market deals. A lot of what I acquired, and I've stopped buying commercial retail centers probably about 2 years ago. Not because I've had a terrible experience. I've certainly learned a lot through that, but it's also just, like I said, a lot of work dealing with the banks every single year. It's kind of this playing catch-up game, and this is with any asset class that we buy, because it's like, okay, we earn good money in our business. Now we need to find enough real estate to offset it, and it's always like, going through that path. But I just I did not want to own any more retail centers. Like, we had enough. And so now we've transitioned more to back to the residential. And I will always hold about 30% of my portfolio in single family, new construction, A-class assets, because honestly, at the end of the day, those appreciate way better than any other, multifamily, retail, anything else. Like, good quality new construction in an area that has an undersupply of housing, those things will just appreciate to the moon. And so I love that asset class. Now we're buying a lot of like higher end short-term rentals, luxury stuff here in Colorado as well, which that's a lot of fun as well. But deal sourcing, pretty simple. I mean, we had a great broker who is now kind of acts as a asset manager for us, because he's intricately familiar with all the deals as well. Even though we have an actual property manager, he's reviewing keeping them in line and reviewing all the financials. But it was just underwriting the deals. So a lot of what we bought was still when rates were lower, and we were buying 6 or 7 caps on these deals, and then maximizing the tax benefits on them.
Now, so let's talk about rent to retirement and the origin story of the company, because it's become, I'd say, a household name in the real estate industry. So I'm curious, and I've always been curious about, like, did that company start on the back of an envelope? Like, kind of like tell me about like where the idea came from and kind of how you scaled it from there.
No pun intended on the household name, right? So the and yeah, I mean, we've really become familiar in the real estate community for when people think about turnkey or build to rent, which has been our goal. And a lot of that is through word of mouth and just organic growth, as well as just growing our business and marketing and all the things. But we do a significant volume of transactions across the country every year, helping people build their investment portfolio, where we handle everything for them, right? So when you think about turnkey, this is the first thing we do is we analyze markets to understand where the best deal structures are in the residential sector and single family, small multifamily sector, right? These are 2 to 4 units or single family standalone homes. Majority of what we do is new construction. And so we build houses. These are in A-class assets. Some people, when they think about turnkey, they think about a Midwestern $100,000 house. It's a D-class asset that has a little bit of like rehab on it, and that's not us. We do new construction, A-class assets in different parts of the country where there's growth potential, there's still positive cash flow, and you can actually buy property significantly below market value, which I'll talk about with some, and also have some unique structures on loans where you can put like as little as 5% down. But we started this company, Matt, simply because we wanted the ability to ourselves to invest in different locations outside of our own backyard. And it was very difficult to do that for my wife and I starting out. We made a lot of mistakes and had some really underperforming assets, didn't do due diligence, not know how to analyze markets, interview contractors and property managers, all the things. We did everything wrong. And so we were determined to build a better process and approach to do that. And it took many years to do that. But, there was a point in time where, I remember some of our optometry colleagues just at some of our, we'd get together like once a year occasionally, and they just ask how things are going. And some of our first investor clients were our optometry colleagues that were like, hey, we see the success they're having in real estate. I want to do that. I want to invest in real estate too. I don't have the time. Our local market doesn't make sense. So we don't have the experience. Like, can you help us? And so we just helped investors follow the same path that we were, which is really meticulously and methodically identifying the different markets throughout the country based on all the criteria I mentioned, and investing in areas where we know we're going to have a sustainable portfolio and maximize appreciation and rent growth and things like this. And then just realizing like, hey, there's a bigger demand for that beyond just our immediate network. And we already had the infrastructure in place to invest ourselves in these different areas. But we've kind of made the transition over the past 5 or 6 years to almost exclusively focus on new construction for all the reasons I mentioned. You attract the best quality tenants. You have really low maintenance. In fact, the first year you should have zero maintenance. You have builder warranties. It's just a really quality asset that you're going to own, and it's going to appreciate and perform consistently over time. But where our business gets really unique is that we do two things, Matt. One, we build houses and, lease manage them for investors and sell those. The second thing, but that's a small portion, like our own builds are probably 10% or less of what we sell. And we sell thousands of houses, across the country. And so, that's a lot of volume to cover. So what we do is, on a broader scale, is we're able to actually go in and partner with national and regional builders. These are award-winning quality builders like Toll Brothers, Lennar, LGI, D.R. Horton, that build all across the country. We get to cherry pick the markets that they build in, that we see the best investment opportunity. And then because our community as a whole has a lot of buying power, able to buy thousands of houses, we can go to these builders and work with their wholesale division, not their retail division, like, the average investor would, that maybe is buying 1, 10, 20 properties. We're able to work with their institutional wholesale division, like a private equity firm would, or like Blackstone would, that's coming in and also buying thousands of houses, and negotiate preferential pricing. So we actually get wholesale type of pricing that we're able to pass on to the individual investor. And this is significant. So these are sometimes upwards of 10, 15% below market prices. So on an average $300,000 house that may be renting out at $2,500 a month, that will still produce a 10 to 12% cash on cash return for someone that's using leverage on it, they can buy that $300,000 house for $260,000, $270,000, where it's steeply below market value. But the best part is that working with these builders uniquely like this, because of the negotiation power and the business we've built with them, investors don't have to take that just as equity. That's true equity because they're selling the same houses at full retail value. That's true equity. The house will appraise for more. But you can actually get that money back at closing, right? That's something unique in our industry that we've been able to do that no one else has been able to. So on a $300,000 house that's positive cash flow, you can either get a steep discount on it, it's called $30,000, $40,000, or you actually get that money back at closing, which is huge, right? Because if you're using a 10% or a 20% down payment, you get 10% of that back immediately. That skyrockets your ROI. And now you're able to acquire more assets with the same amount of capital. I'll say one more thing on this that I think is important for people to understand. That's the buying incentives. That's a benefit of being part of our community, is access to those type of deals where we've already done all the market research across the country and we handle everything for them, so they're not having to self-manage. We also have unique partnerships with lenders where we can have investors that buy multiple properties with as little as 5% down. These are true investor loans. You can buy multiple properties with 5% down. You have to still qualify. So if you think about this for a moment, if you're buying a brand new construction $300,000 house in an A-class area that you're putting 5% down on and you're getting 10% back on that, it actually allows you to acquire an asset for no money down. So my point is that on the residential side, like, it's not just about buying turnkey properties. It's about matching the right buying opportunities and the right lending opportunities to really offer a unique investment experience for someone that helps them scale in that sector faster than they could otherwise. So I know I went on a rant, but I just wanted to tell you a little bit more in depth about like what our company actually does.
Zach, this is one thing I've actually been always curious about, and I almost forgot to ask you this question. Is I remember rent to retirement having like 2 to 3% loans in a 6% interest rate environment. How did that deal work? Because I hear the ads about it and see it on your website. Like, how did you actually structure that to achieve like lower rates like that?
Yeah, those were seller financing. Those were short-term, interest-only loans, anywhere from 3 to 5 year terms, where it's a seller finance loan at 2.99. And I think it was at 1.99. So yeah, 2 to 3%. Um, so that's a unique. That's just one example of multiple creative ways that we bring to people from a lending perspective that are options for them to acquire, because those properties cash flow like crazy, right? And yeah, you would, if you're looking at if it's a 5 year loan, I mean, you cash flow the heck out of the property, and then 5 years later, you have to put a different loan structure in place or sell it. You would have had appreciation likely, and that because those are all new construction assets as well. So just understanding what your exit strategy is, but also likely within a 5 year period, you would have had quite a bit of rental increases as well. So that would have been able to likely absorb a higher interest rate as well. But yeah, I mean, the goal is we're to always look at different loan options that we can bring to people to be creative, just like with the 5% down loan option, where people can buy up to 5 properties with 5% down, and match that with a market that makes sense for them, with a new construction asset that's going to be a quality property that's going to appreciate over time, where it's going to be generally hands off or not having to be an active investor, and then matching that with the best buying opportunities. So it's all these things. It's about building a strategy, right? It's all these different levers that we can pull, and I love educating people about these things, because a lot of times when they come in the residential sector, they're like, oh, you can't, you need 20% down for a single family house. And I was like, no, you don't. Well, here, let me show you these different loan options. Or another common thing is like, well, it's cash flow or appreciation, so which one do you want? Or the reality is you can have cash flow appreciation and equity in the right market with the right asset class with the right terms, right? And the biggest, when people hear about turnkey, some of the biggest concerns they have, or obstacles or feedback is, well, you're buying an overpriced house, they've already done all the renovation on it, or it's at market value or above market value. And I'm going, you're buying with the wrong people, right? I mean, look at what we're just talking about today. You can buy a new construction asset 10 to 15% below market value, where you could almost immediately cash out, refi, and pull your money back out of it, right? It's just about understanding the different options you have. And we try to present all those things to people. So yeah, that was a great example, and I think we sold 300 houses with that loan product.
Excellent. You mentioned market location and the research behind that. I mean, regardless of what asset class investors looking to invest in, everybody's looking for the right market. So I guess, what's your methodology on what you look for in identifying those markets to achieve the objectives of yourselves and also the clients for your company?
Yeah, and I'll preface this, Matt, with saying that what is the right market for one person may not be the right market for the next person, right? So it's all about matching the market and the property and the buying opportunity and the lending and all the strategy with what aligns with the person's goals. And the only way you can do that is working with the individual on an individual basis to understand what their goals are, and then like trying to help them navigate this. The tax side and the buying side, all these things are really important. But we do have fundamental criteria that we want to meet for every market that we're at. Excuse me. We want to be, we work two main geographic areas, Midwest and Southeast. So Midwest would be like Indiana, Ohio, Missouri. These are your traditional B class, turnkey properties. Some new construction, some rehab stuff. $150,000 house on average. In the Southeast, which is about 70% of what we do, these are more growth markets. These are all new construction. Price points are a little bit higher, 250, 300,000 on 4-bedroom, 2-bath, A-class new construction assets. Still positive cash flow, but a little bit more expensive. And these are areas like Texas, Alabama, Georgia, Florida, Carolinas, a lot of the Sun Belt, the growth areas. We want to be in areas where we have a diversity of industries, not an area that's just, say, reliant on oil or gas. One industry could change over time. We want to be in areas, obviously, where there's population and economic growth. I mean, look, don't overcomplicate it either. Supply and demand drives all economics, certainly drives housing. So areas that have an undersupply of housing, where there's population growth, I mean, there's more demand and growing demand. Those are areas you want to be in, and will be well positioned to have growth over time. We want to be below the median house price point. So median house price point in the U.S., give or take 400K. Most of our houses, as we just mentioned, 200,000 to 300,000. This is more affordability. This gives you the highest demographic for tenants and resale buyers, right? The retail buyers when there comes time to sell the house, because our average holding time for investors is 4 to 6 years. They build up equity through appreciation and debt pay down, sell a property 1031. Trade up, maybe trade into commercial or whatever the case is. But that's the typical path. Those are areas where we want to focus on. Of course, we're paying attention to things like legislation. We want to be in areas that have landlord-friendly legislation, where we don't have problems evicting tenants or imposing certain fines, things like this. We want to be in areas where you have favorable tax structure, both from property taxes, but certainly from an income tax standpoint in these areas that are business friendly. So, I mean, these are all really important things to focus on, just strong real estate fundamentals, demographics. And I will say one last thing that we've been really successful with lately is being in what we call kind of secondary or tertiary markets. These are areas within a 30 to 60 minute commute outside of a large MSA area that may be inaccessible to be successful. And a perfect example of this would be Orlando. Orlando is too regulated, too expensive, too popular, like too much demand or too much investor activity. And so, but we can be right outside of Orlando and say an area called Polk County or Poinciana, it's 30 minutes outside. Rents are still relatively high. Houses are a fraction of the cost. And a lot of people are moving to these areas because they're more affordable. So anyways, those are just some of the things that we're looking at.
Now let's talk about trends you've been seeing in the industry. I mean, anything of note that you can bring as an insightful to our listeners, such as, even occupancy rates, vacancy collection loss, delinquency, price per square foot on what you're seeing in building that our listeners can take away.
Yeah, trends are always changing, and here's the thing with trends is they're always hyper local. Often, I think a big mistake people make when they're trying to evaluate areas, they actually look at trends at too large of an area, because trends can vary dramatically from even within a small area in a different asset class, right? So we track a lot of the trends that we focus on. I think nationally, some of the trends we're looking at, it's no secret or surprise that real estate market has been somewhat stagnant over the past couple of years, but there's also been a lot of areas that have double-digit appreciation growth and have not had any stagnation. A lot of those are some of those southeastern markets, and so I think people will be rather surprised that just I think opening them up. If you're an investor that hasn't been open to or really discovered or looked into investing out of state, I encourage you to do that just for comparison, right? Like, what's the harm in doing that? And it also puts your own market into check a little bit to understand, like, is this the best area for me to be investing in? And probably the answer actually is probably not. I mean, yes, you have a strategic advantage because you're local, but there's likely a better market out there that's just performing better, more conducive to your goals. So I know I'm getting sidetracked, but start monitoring some of these trends. Some of the trends we want to focus on is, what is the average leasing time, days on market? What is the supply and demand demographics? A lot of this is just general census data, but it is very broad. And so as long as you can focus on like a specific area and be real hyper focused on a neighborhood, general geographic area with a specific asset class, I think that will allow you to hone in. Like, our average rental increase over time or year after year is 6.5%. That's double the national average. So we're able to increase rents over 6% on average per year. We've averaged over 9% appreciation over the past decade per year. Now, some of these years have been much greater, some less, but we still see a lot of markets that have double-digit appreciation right now. Because if you're buying a $250,000 house that's renting out, whatever, $2,200 a month and has good cash flow, that property's probably not going to get any cheaper over time, right? Your upside threshold is much greater. So I don't know. A lot of trends vary, Matt, in the different areas depending on where you're looking, but that's why it's important to familiarize yourself with the area you're looking to invest, and always keep that in check and compare and contrast with other areas. But I think we're positioned to have a strong real estate market as we hopefully will continue to see rates come down, new administration, new policy, all these things I think will drive more activity into the market from both buyers and sellers.
Yeah, I'm not going to ask you about where interest rates are going because I know don't have a crystal ball. But the last question I want to ask you, though, is if you are a real estate investor that's out there that's looking to scale and scale whether a single family portfolio or a large multifamily portfolio or commercial retail or commercial industrial, and you own a couple of rental properties, like what is your advice on actionable types of things they can do today, this week, this month to think about scaling their business in the future?
So if it's, the things we talked about early on about the systems and replacing yourself and finding good people like that takes time. And so I would encourage everyone to still do those things. And, also be slow to hire. Sometimes I think often people jump into partnerships too quickly. I certainly did, and hire people too quickly that they just didn't take the time on just because they, met someone easily and liked them. Because that can actually set you back. But to answer your question, like some tangible action steps to scale that you can do today, or at least start educating yourself on today. Number one, again, if you are finding your local market to be challenging to scale in, or if you are heavily invested in your local market, start analyzing other markets and start just being aware and conscious of different buying opportunities. Maybe also looking at other asset classes. That would be true as well. If you remember in the beginning, I told you that opening up our mind to investing out of state was this like the single most impactful thing we did that changed. Like it was an impetus for this business, as well as just allowing us to scale our portfolio. Educate yourself on different loan options and evaluate your resources. Most people have a lot of resources available at their fingertips that they're not even utilizing, whether this is money in a retirement account, equity in a house, partnerships with certain people. There's a lot of resources available. Make sure you're educated on different loan structures, because again, all the time people think that, there's only one way to do things, only one loan structure out there, and there's simply not. But the biggest, most impactful thing, which, I don't know when this will come out, but, if it's before the end of the year or this is relative to any time this comes out, the thing that made the most difference in my investing is understanding the tax code and how to be a sophisticated real estate investor. And this isn't rocket science. Understanding how to utilize the tax code to your benefit, because that's the most impactful thing you can do. Taxes are the biggest expense we're all going to have at any point in our life, and that's the easiest way to give yourself an immediate large raise is to pay less taxes. Using things like accelerated depreciation, cost segregation, if you can, whether you're a real estate professional or you go do a short-term loophole, which we help a lot of investors with, to save tens of thousands, if not hundreds of thousands of dollars in taxes every year that they can reinvest to buy additional property that has additional tax flow or tax benefits and cash flow and all the things. Doing things like 1031 exchanges. Like once you really understand the tax side, that's things that you can do now, that will save you more money, that'll help you reinvest and expedite your goals. So those are hopefully a little bit of nuggets of knowledge and like the most impactful things to focus on immediately.
Excellent. Zach, you've been generous with your time. How do our listeners learn more about you and Rent to Retirement?
Yeah, we have a large podcast and YouTube presence. We put out a lot of information just about market data, investment calculators, all the things. So if you're interested to learn about some of these loan structures I talked about just market data in general, understanding different areas. If you're interested in, new construction turnkey investing and buying steeply discounted new construction properties, we'd be happy to connect with you. We want to drive you to our website. That's rent2retirement.com, rent-to-retirement.com. Put out a lot of information publicly available. If you're listening to this audio, you can text REI to 33777 and set up a time with our team to go through your investment strategy. We don't charge investors anything. We make our money through buying and selling houses. So we're here to just completely add value and help you scale and diversify across the country into the best markets.
Excellent. Zach, I look forward to seeing you in the green room, man. Thank you so much for coming on.
Thanks, Matt.